the individual who just joined with the phone number ending in 21, could you please announce who you are?
You want to handle with Wells Fargo?
Thank you.
You guys hear me?
Hello, Jack. Hello, Steve.
Hello.
Hello, Scott.
Good afternoon.
Okay, let's call to order the Finance Committee meeting of
We can do the majority of it.
Okay.
who else is on the line?
I can see Gary Gray and Matt Sansberry, and on the phone, there's 3 people on the phone.
Could you identify yourselves, please?
Nick Ayat, PNC Bank.
Somebody else?
Do you want to hand Wells Fargo?
And there's one more. Sorry, phone number ending with 01.
Okay, we have one undisclosed member or person on the phone. It's okay.
Yeah, it's area code, starts area code 917 and ending with 01.
All right, let's get going. So the first item is approval of the agenda. Any questions or comments on the agenda?
Move approval.
Okay, all in favor?
Aye.
Aye. Agenda's approved. Approval of the minutes of December 3rd. Any comments or on it? They're attached. Okay.
Yep, there it is.
Okay. And we go to, well, no, any comments? Is
No
there a
comment.
motion
Move
for-
approval, whatever.
Second? All in favor?
Aye.
Motion passes.
Aye.
Public comments. We've got some guests here. If you all want to identify yourselves, we didn't give you an opportunity before, but go ahead, Mike. Start with you. Great, thank you for being here. Any public comments? Items for approval. The first item is market update. Again, is that Steve?
I'm not sure if it's
Steve
Steve
or
or
Scott.
Scott, but one of you is going to be doing the market update. So, and I think you want me to look at your March report, is that correct?
Correct.
Okay, so just tell me when to change slides, and I'll move them for you.
You want me to go ahead with the market update, Steve? All right, I'll take that as a yes. I think he's frozen. Good afternoon, everyone. I'm Scott Sweden with PFM Asset Management. And looks like we're on slide 4, correct?
Yes.
Okay, there we go. Current market themes, I'll basically just provide some updates and refresh some of the data as we move through the commentary portion of it. But forefront and still very relevant, the invasion of Ukraine by Russia. That has further exacerbated any of the inflationary pressure that we've been dealing with. Commodity prices have soared. Energy certainly has gone up in a dramatic fashion as well. I think from an export standpoint, I don't think a lot of people are aware. Ukraine is actually, for all intents and purposes, the breadbasket for Europe. They're typically ranking in the top 10 as far as exports for corn, barley, wheat. I believe they're number 1 in sunflower oil. We often hear quite a bit of headlines as far as the supply chain bottlenecks with semiconductor chip manufacturing. Ukraine actually supplies 70% of the inert gases that are used in the manufacturing of semiconductor chips. So that also is going to further exacerbate some of the issues we're dealing with there. But on a much more positive note, looking at the U.S. economy, the labor market continues to strengthen. The unemployment rate currently for the April data, that came in at 3.6%. That puts us almost in line with where we were at pre-pandemic. February of 2020, unemployment rate was at 3.5%. Labor force participation rate, I believe, was around 63%. Now we're at a 62.2. So from a labor market, we are approaching, if we have not yet, full employment. So now the Fed is exclusively focused on trying to rein in inflation, as we're well aware. I'll provide some updates on the Federal Reserve. I think we're all aware they've raised rates 75 basis points to date. There are roughly 8 rate hikes priced into the market currently. Most experts are forecasting at the next 2 meetings 50 basis point rate hikes at each of those sessions, so we'll stay tuned to that. They're going to further reduce the balance sheet, and I'll provide some updates on the Treasury yield curve. It changed dramatically in the fourth quarter of last year, and even more significantly in the first quarter of this year as well. Leanne, you can move to slide 6.
There we go.
Now, this really kind of addresses inflation. It addresses, many experts believe the Fed was way behind the curve as far as taking the stance that it was initially transitory, then they moved away from that terminology. But you can essentially see March of last year, the consumer price index was at 2.6%. Unemployment was at 6%. Two-year treasury yield, 16 basis points. We were projecting 0 rate hikes for the calendar year of 2022. Then you really start to see things heat up mid-year. CPI jumps up to 5.4%. Unemployment, slight downtick to 5.9. Treasury yield bumps up to 25 basis points. Still no projections. You really fast forward to the end of 2021, the CPI was at 7%. Unemployment rate improves dramatically down to 3.9%. The two-year treasury yield ended 2021 at 73 basis points. And we start to really factor in some rate hikes in 2022. And at that point, we were only factoring in 3. We get into 2022. The reading at that time was 7.9%. The most recent number there is actually 8.3%. That was the April data. And on a positive note, that's a slight downtick from the March number. So a little bit of an improvement there, but still at very elevated levels. Unemployment rate, 3.6%. And then now we start to factor in 7 rate hikes in 2022. So no matter what economic indicator you're looking at, CPI, producer price index, personal consumption expenditure number, year over year, they are at historic levels, roughly at 40-year highs. So that is going to be the focus for the Fed going forward. They've been very transparent that they're going to be as aggressive as they can to try and rein it in. We can move to slide 10, Leanne.
Okay.
And pretty much here, this is referencing the inverted yield curve. It took place early 2022. It was a very short-lived inversion. And why is that significant? It's when the 2-year treasury is yielding more than the 10-year treasury. Historically, that's been indicative of an upcoming recession, maybe 12 months or longer down the road. So from here on, as of March 31st, you can see the 2-year was at a 246 yield. The 10-year was at a 234. And just to give you an idea where we're currently at there, let's see, a 2-year is at a 257. So again, yields have continued to increase. The 10-year right now is actually at 277. So that inversion no longer exists. And really the story here on the left side that we're looking at, the light blue line was the end of 2021. And then the blue line, which is almost a vertical line straight up, that is at the end of the first quarter. So I think we're all aware there is a inverse relationship with yields going up, the prices move in the opposite direction. So that being said, looking at the right portion of the screen, this really tells the story in a nutshell. Within the fixed income space, there was no place to hide. Looking at a 1-year treasury return in the first quarter, negative 80 basis points. A 1 to 3-year treasury, that was down a negative 234. A 1 to 5-year was down a negative 3.16, and a 1 to 10-year was down a negative 4.02. And just to put this in a perspective, the 1 to 3-year treasury index from a historical context, that was the worst performing quarter since 1980. And we can move to slide 14. Thank you, Leanne. And again, this just kind of captures everything just in a different format. again, no matter what sector you were investing in the fixed income space, treasuries, agencies, asset-backed securities, corporates A to triple A rated or triple B corporates. In the first quarter, you can see the negative returns across the board. As the investment manager, we like to look at things longer term, and you can see over a 10-year average, each of those asset classes had positive returns over the long run. Again, this is, for lack of a better term, this is a little bit of the cycles that we go through in the market. The fourth quarter and the first quarter were very volatile. They took pretty much everyone by surprise, even the Fed as well. And we are navigating our way out of that. Still managing the portfolio for safety, liquidity, yield. We are finding value, and I will give you some specific examples as we move along. We can jump to slide 18, Leanne.
Okay, there we go.
Thank you. And this is an account summary. So just taking a look in the upper left quadrant, the total program assets as of March 31st, 1,730,421,561. You can see the breakdown among the managed account, bank deposits, Florida Palm, Florida Prime, and money market funds. The upper right quadrant, you're looking at the sector allocation. You can see you're very well diversified across the board. For the most part, pretty heavy concentration in commercial paper there. And that's reflected on the bottom portion of the slide as far as the maturity distribution. You're looking at roughly 60% of the portfolio is under 30-day maturity. You can move to slide 19. And again, this is just an account summary for the core portfolio and also the short-term portfolio. And the one thing that I would touch on really for the core portfolio, if you take a look at the yield at market, you can see yields have gone up dramatically. So that 2.14% is a good indicator as of March 31st where we would have been putting money to work. So we are finding much more attractive yields than we've been accustomed to over the last few years. And below that, that's the short-term fund. And again, you're looking at roughly maturities of 30 days or less there. And we can move to slide 20, Leanne. Thank you. The next few slides are really for compliance purposes. The gray portion, this is the sector allocation analytics. So the gray portion of the bar is indicating the maximum levels permitted by your investment policy. The blue shaded region is where you were allocated at the end of the first quarter. And just a quick takeaway, you can see we have a very healthy buffer between where you're allocated and the actual limits of your investment policy. As the investment manager, that really puts us in an ideal position. We're able to be very flexible and nimble. And when opportunities do arise in the marketplace, we're able to take advantage of that in a very efficient manner. And we can move to the next slide, Leanne. Thank you. Now this is the max maturity analytics. And again, the gray portion of the bar is indicating the maximum maturities for each of these categories permitted by your investment policy. The blue shaded region is where you were allocated at the end of the first quarter. So again, for compliance purposes, you're in great shape there as well. And the next two slides, to me, I think that's just an overall great view, a bird's eye view, if you will, of the account summary. You can see the various security types, the percentage of the portfolio that they comprise, and then also, this is an enhancement on our newer reporting, but you can now see ratings from S&P, Moody's, and Fitch. And oftentimes that can be a bit interesting. You can see split ratings because quite a few of the rating agencies changed some of their methodologies last year and also through COVID. So I just think that's a great overall snapshot of the portfolio. We can move to slide 25. So here's a snapshot of the core portfolio. You take a look at the total market value at the end of the first quarter, 107,546,268. The portfolio effective duration, 1.7 years, so slightly below the benchmark effective duration, so a little less sensitivity to interest rate movements for the portfolio. And again, looking at that yield at market, 2.14%. Again, just giving you a good idea of where we are investing. We're actually investing above that currently. Portfolio credit quality, AA. Again, upper right quadrant, that's the sector allocation breakdown. The bottom right quadrant, you're looking at the duration distribution. So again, we're slightly less than the actual benchmark duration. And the bottom left quadrant, you're looking at the credit ratings by Standard & Poor's. And we can actually just move to slide 28. This will give you a good idea of the activity that took place in the portfolios in the first quarter. The blue portion of the bar is indicating purchases. We continue to find value in the corporate space. Initially, it started out primarily with financials, predominantly bank names. Now we've actually broken out a bit into the industrial space. We're finding some very attractive yields there. And the gray portion of the bar is indicating maturities or sales. So you can see a little bit of that on the corporate and treasury side. The right portion, that's just broken out in a numerical fashion for you. And we can move to slide 29. Thank you, Leanne. So I think I've painted the picture to the best extent that I can, but essentially there was no place to hide in the first quarter or the fourth quarter of last year in the fixed income arena. But performance in the first quarter, the benchmark was actually a negative 2.34%. The portfolio came in at a negative 2.24%. So we never like to present negative performance numbers, but we still were able to outperform the benchmark in a very volatile time period. Over the last 12 months, really you can see the significance of the fourth quarter of last year and the first quarter of this year. That actually took the 12-month numbers negative to a significant fashion. So the benchmark was down a negative 284. Again, the portfolio was a negative 262, so we still outperformed the benchmark over that time frame. And looking a little further out on the time horizon, we outperformed the benchmark over a 3-year, 5-year, and 10-year period by a pretty healthy margin for most of those. Any questions at all yet? Probably should have asked a little sooner before I got into the portfolios, but okay, I'll take that as a no for the time being. We can move to slide 31, Leanne. Thank you. This is a nice breakdown as far as the total earnings that we've been able to essentially add value to the portfolio. You can see over a 10-year period that we've been able to add roughly a little bit over $8.5 million in total earnings. So again, during these time periods, we need to focus on where we're adding value and essentially just trying to improve the portfolio wherever we can. One thing I would like to point out, I've spoken to some of the attractive yields that we've recently been able to find. If you can move to slide 42, Leanne. And it's going to be the third one down. We were able to get a Home Depot corporate bond, trade date March 24th, so right towards the end of the first quarter. We were able to get that at a yield of 276. So you start to see these yields are becoming much more attractive. Take a look at the next page, page 43. We were able to get Citigroup corporate note at a 329 yield. So again, the nice thing that, well, essentially the nice trade-off here is any of the unrealized losses that you're looking at in the portfolio, the fact that we're able to reinvest at these much more attractive yields, that's going to provide a bit of a cushion going forward. It's certainly going to reduce the unrealized losses that you're looking at. And as things continue to improve in the marketplace, we should be able to turn this ship around and be in a much better position going forward. And if we can jump to slide 51. It's just going to be a recap of the short-term portfolio. Total market value at the end of the first quarter, $709,325,746. And again, the effective duration is essentially less than 30 days. You can see the yield at cost, which was essentially what the portfolio was earning, and the yield at market, which would be where we were reinvesting at that time. Sector allocation, 100% commercial paper. And so really not too much else to get into on that, but I would point out on slide 53, again, from a value perspective, over the last 10 years, we've been able to add a little over 24 million in total earnings for the portfolio. And I think those would be all the prepared remarks I would have. I'll defer to
Scott, this is Leanne. I wanted to jump in for a second. On the short-term
Okay.
portfolio, if you remember, last year, actually, I think it was the last 2 years, we were using just overnight securities, money markets, local government investment pool, because you couldn't get enough return to offset just the safekeeping, the custodial fees of holding the securities. So this is the first time in a couple of years that we've purchased securities, and it's a lot of commercial paper. I know it's short-term, it's all laddered, and for the first time, we didn't ladder it all the way out because we knew rates were rising. So we kept them regular, very short, and as things mature, we're reinvesting them as they come up for mature and spreading them out, because we're constantly looking at how much we can invest in for how long we can go out. So it's a lot more active management of the investments right now than we've had in quite a few years. And I'm sure that's typical of what everybody else is doing in the world too, but it's different than what you've seen from us for a couple of years, so I wanted to point that out.
The safety of the commercial paper.
Oh, Scotty's question was regarding the
view-
safety of this commercial paper.
You can see the portfolio credit quality A-rated or better. So you've got 88% of the commercial paper at an A1 rating, and 12% is at a A1 plus. So
Down here.
again, you're really only looking at maturities going out roughly 30 days. So minimal risk, if any.
Well, I guess the other risk is just such concentration. We have had problems sometimes, I think, with the commercial paper markets.
Right, but I think because we're keeping it so short and it's well diversified, when you look at that other chart up at the beginning, it showed the entire portfolio, not just the transactions. I'm heading way up here at the beginning. When we had the list of how well diversified the portfolio is, and that's really key to show how it's split up. You know, it's commercial paper, yes. There's a list of commercial paper, but it's spread across a lot of individual companies.
Yeah,
And
I'm thinking back when the
actually-
commercial paper was a problem because I guess the
Liquidity market?
liquidity market was bad.
Yeah, I don't think that liquidity is an issue right now the way it was a few years ago when liquidity was the key driver.
2007, 2008.
Right. We aren't having that same issue in the market that I've heard of. I've not
I
heard of
know,
any
but I
liquidity
think
issues.
No.
something that I'm just
Right.
pointing out.
Mm-hmm.
And you can actually see the portfolio holdings on page 54 and 55 for the short term.
Okay.
So you can actually take a look at the diversification.
Yeah, actually, this is Steve Alexander. If I could just sort of chime in on that point. Actually, there's probably too much liquidity in the marketplace. And that's part of the reason why the Fed is trying to raise rates to slow down that liquidity, that which has caused all this inflation. So liquidity is certainly not an issue.
Yeah, well, that was the question.
Okay, any other questions on, gosh, we've got a lot of echo. Any other questions on this portfolio? Because this is, and we're showing you March. We didn't meet to go over December. So I'd like to, we've got the December one here. We were in full compliance with the investment policy. I really didn't want to focus on December because it's old data at this point, but the committee had not reviewed it. So we have it here. At this point, the important thing is that we were in compliance with all the compliance issues related to diversification of investors, all the limits on how much we could have invested in commercial paper. We spent a lot of time placing securities in December. That's when the tax revenues come in, and we got it all placed. And that's really what you saw with March. Some of it's been sold or matured and then reinvested. So what I'd like to do is show the district report, if I can get the right one here. This is the district version that we keep. And we do it ourselves as well, just as a double check, so we can tie out and make sure that we're in sync with what PFM's presenting, that we all have the right data. So this is showing, and I went back and listened to what I talked about back in December. I said, wow, it's pretty much the same story. The dotted line here is what interest rates are in 2022, and it's very different than what it was in 2019. But those rate hikes that we see coming are going to, hopefully, we'll start seeing interest earnings grow significantly. And we have quite a bit of cash in the portfolio. We're at $1.9 billion. The returns, you saw that already through PFM's presentation. But we're showing, this is the total portfolio. 1.9 billion total. And this is the investment portfolio, cash for schools in the district, the local government investment pools. I show the pools a little bit differently. We have part of it that's in overnight, and then we use Florida Palm Term, which is when we go to PFM and they, through the pool, buy specific securities for us with a specific maturity date. So it's not overnight liquidity. It's almost like a second separately managed account, but done through the pool. And we've seen very good returns there. So we've actually reduced the amount we have in pools overall because we put it out in, it's a pool, but it's not that overnight. So we're tracking, that's the way the investments are at this point. I don't see a significant change coming up in the next few months. We do have some big debt service payment is due in June. We'll wire out a little over $1 million for debt service in June. So we'll see these numbers start to come down a bit, but that's the picture of the entire portfolio. And this is the way we're looking at it across the board. And this is the projection. This is a slide that I use quite frequently. Now, I'll tell you, this is what we project. This was the projections for April through June, and that's not what we did. The red is cash sitting in a bank, and we did not have that. It was reinvested. So the projection just hadn't been updated through this, but you can see the amount that we have invested in short-term investments. This yellow is Florida Palm. It's the Florida Palm Term. So it works similar to a short-term investment. So we've got a lot invested this time rather than using money markets and pools. And I'm looking at Paul when I'm saying this. I'm guessing they've done the same thing with their portfolio. And this was the list of all the investments. And then I'm going to skip down. The last here is the sales tax. Like we just had the sales tax oversight committee meeting. But this is the report that we track, and it does show that sales tax revenues are coming in at 118% of projection, so well above what we had projected it to be. And I've shared this with the sales tax committee. At this point, barring an economic recession, which I keep hearing more and more about, I gave up trying to predict what this would do, but if it continues the way it is, we will trigger the sunset provision on the sales tax, and it would end in a year early. But it's something we monitor month to month to see where we're at. The line of credit that we're going to talk about in a little bit, that's done really well. The fees associated that since we put that in place back in 2018, only $350,000. It's at 10 basis points for an unused fee, and that allows us to go ahead and put budget out there and start spending for projects to expedite the work that's going on throughout the district. I think the only thing left in the portfolio is behind this, you all have always asked for information on the money market, so we've attached that. That backup information is there. This is the first time the investment reports are getting bigger because we keep adding more information to it. We had to, if you see the name of the file, they all have a little C behind them. We've had to compress them to get them loaded online because the document is so big our website can't accommodate them the normal way. So we're probably going to look at breaking some things up and provide things as in a different format rather than making it bigger and bigger. And I don't want to get to the point where we can't load these on the website for the public. So we've got to do a little work there. But are any other questions on the investments and from Scott and Steve? I don't know if there's any wrap-up comments you wanted to make. We lost Steve for a while. On the investments? We've been keeping them rather short because when you're in the rising interest rate environment, if we lock it in longer, we'll have... Steve or Scott, did you hear that question?
I did
With
not.
the rates going up, will you be investing a little bit longer soon, or are you going to just?
Yeah, so is Rick Miller asking that question?
Yeah.
Yes, it is.
So back, if you, I don't know, Leanne, you had that chart where you showed the high compression of all your short term and that, the chart that gives you a mental breakdown
Yes.
when you look at that chart with all those colors compressed. Yeah, so right there in that upper right hand where all that short-term assets at. So the trick, of course, is going to be at some point here, maybe it's later on this year, do we hit a recession? Meaning that has the Fed raised rates enough, or did the market react enough already just in the anticipation of Fed increases? So the market's already put in a lot of Fed increases already just in the anticipation. And so at some point later this year, beginning of next year, we may have a whole different discussion going on about lengthening the portfolio, going out a little bit further to lock in the rates that we're seeing that are so attractive right now. And they may dissipate. I mean, that's what the Fed is trying to do. They're trying to slow down the market. They're trying to slow down inflation. And so the big question is, of course, when is that recession? Do we have a recession? I know a lot of people have been talking about a soft landing. Of course, those are wishful thoughts. Most likely won't have a soft landing. There will be some type of recession. And I would point you to what's happened to Walmart and Target. And to me, those are leading indicators that potentially a recession is coming. If Walmart and Target is having inventory problems, that tells you a lot about the consumer's demand for products. But we'll have to see. But at some point, and it may be later this year, beginning of next year, we'll have a different discussion. Right now, we're enjoying these rising interest rates. Short-term investments actually have a yield. It wasn't too long ago that all the pools were at 5 or 6 or 7 basis points. Now we're looking at 80, 90, and the term rates at Florida Palm are over 1%, 120, 130, 140, depending how far you go out. So it's a whole different part of the interest rate cycle. But how long is that going to last? And the question will have to be asked, and the strategy will have to be put in place on lengthening the various portfolios and the strategies. But that's still to come, and we have to keep a watchful eye on it. It depends on the reaction to the the Fed increases and the interest rates, and what the consumer going to have a continued appetite for spending, which I have the feeling that's going to come to an end here as consumers are starting to pull back, and I think you'll see more evidence of that over the next couple months.
Yeah, well, I guess you got to keep a track of it, but the problem is figuring out when that is, and you don't want to be behind it. You don't want to be to the point where the market's
You
coming
want to
down all
lock
at
in
the
the
same
rates
time.
when
You
it
wanna-
makes sense to lock in
yeah,
rates.
you don't want to take the last chance on it because
Well,
it's like everybody else does.
it's trying to guess the market, and it's really hard to do that.
That's what I'm getting at.
Yeah. So, we always look at it, how much, I'm looking at it strictly on a cash basis for the short-term portfolio. How much do we have that's available to invest, and when do we need it back? And I actually have conversations with PFM and say, I have this much, I can invest out this far. Show me the rates. Show me what it looks like. And then we pick the right place and how far we want to invest it out based on the information we have. So every time we make that decision, we look at it fresh. Where are we at now, and where do we think we're going to be? And we update that, every time. Every month, we're looking at this again. So,
Okay. Good
okay.
discussion.
Any other questions on investments?
All right.
Okay, so
So we
Mr.
got
Miller,
the
I think
next,
it's time to move on to the financings.
Yes. So you've got financing schedule now.
Do, and we're going to talk about two of them, but I think I'm going to, Laura, talk about the market a little bit first.
Yes, just to kind of elaborate, good afternoon, everyone. If we want to hit to the next slide, just sort of more bad news in in an environment where we're looking to borrow here shortly. If you look on the right hand, or I'm sorry, the left hand, the blue line at the very top is where we are currently. And the chart on the right-hand side shows the historical ranges. Over the past 10 years, in those tan bars, and the dark blue line on the top is where we currently are. So some of those rates on the shorter end, the 5 to 7, 10-year, are at the high of where we've been over the past 10 years. On the next slide, this is just showing where we are for the 10-year AAA MMD versus a 10-year Treasury. So the taxable tax-exempt rates, you'll see in March of 2020, that's when COVID hit and the rates spiked. We're back above those rates now. In addition, they're just like right on top of each other. There's not much of a difference between your taxable and tax-exempt spreads at this point. So for the sales tax, moving forward, we have requested from PNC Bank to go ahead and do an extension of the Series 2019 sales tax revenue note revolving line of credit that we have in place for $80 million. This was set to expire at the end of June of this year, and we're extending it out another year to put in place to finish getting all those projects in for the sales tax revenues as they come in. They have agreed to keep the unutilized fee at 10 basis points, which is great because we've been seeing spreads just increase across the board. There are a few changes in the agreement. The main one, the date is extending to July 13th of 2023, but the main one is switching the formula if we already utilize from 1 month LIBOR to 1 month Bloomberg short-term bank yield. BSBY, first time I've come across this one, but that's with the phase out of LIBOR coming into the market soon. And the spreads were actually lowered a little bit of plus 41 basis points to plus 35. And that only applies if Leanne is actually to draw on it. Otherwise, it's just that 10 basis points.
And I don't foresee ever needing to draw on it. We need the facility just for budgetary purposes to give us the authority to issue contracts. Cash-wise, we have cash and sales tax, and I don't foresee ever needing to borrow. We just need the budgetary authority, so it's nice to get it at such a low price.
Resolution.
Yes.
Sorry, I wasn't on there. This was a motion for renewal, extension of the revenue note. First, made and second. So any discussion on that?
Any questions from our
Questions?
members online?
Hearing none, all in favor?
Aye.
Any opposed? Motion carries. We have further financing as well, COP issue. Leanne?
I want to get started and just explain what we're doing,
Okay.
then I'm going to let Laura talk through all the points.
Okay.
We're getting ready to borrow again, and these are for projects that are in the capital plan. And we're also switching some things around. So some of you, we've got 3 of you here that were at the sales tax committee this morning, or earlier this afternoon. So we had planned projects in the COPS issue. It was a new middle school that's just starting construction and the replacement of 2 elementary schools. We're adding to the COPS 4 large facility renewal projects that were supposed to be funded from sales tax. So we do have, while we have more money coming in from sales tax faster than we expected, we also have rising costs on the construction of these projects. So we're going to take projects originally intended to be funded from sales tax and switch them over to borrow for them instead. And that frees up dollars within the sales tax to deal with the cost escalation we're experiencing on those projects. At the same time, the projects that we're building, that were originally planned to be built, 2 of them have gone up in price. One is an increase of $12 million and one is $10 million. And for the first time, we have 2 projects that will exceed the max cost per student station. So when we do these transactions, we normally repay COPS with local property tax revenue. We're going to have a small amount, probably somewhere between 4 and 6 million, that would be coming from sales tax because the projects were on the referendum list. And the Sales Tax Oversight Committee just reviewed that earlier today. So we'll be using a little bit of sales tax money to make debt service payments with this upcoming COPS.
On the COPs.
On the COPs. And we're going to look at charts. You know, what the big question that we keep asking, do we have room to do this? And we do. And we're going to show you those charts. But I want to let Laura talk a little bit more about the transactions because I've tasked her. I'm not looking at just this deal. I'm looking at all the ones in the capital plan because if we're increasing this first deal to a larger size, I need to make sure that we're still going to have room to do the others. So we've reevaluated all of them in the capital plan. So Laura, I'll let you talk and then I'll interrupt again.
So to kick off, I'm going to kind of walk through what we're going to look at in the graphics on the next few slides. The first piece is going to be the overview, and then we'll drill down into what we're about to do in this Series 2022B. But so what we're looking at for this issuance, which will be the 2022B, is a project fund of $211.6 million. We're looking at this when we're doing this to allow for when we structured this series, assuming that interest rates are going to continue to rise, that we have capacity for these future issuances coming down. So we don't want to put the district in a position that they'll be, going over the target of the 50% of the 1.5 mils when we're doing this, or the potential that housing prices, settle. Decline a little bit, and we want to keep that in mind when we're structuring the debt. We are going to amortize. There's about $85 million of those projects that have a lower useful life, so they will be amortized within the first 7 years to expire on 2029. And then the overage of the cost per student station that's going to be funded with the sales tax revenues will have a final maturity of August 1st of 2025. In case the revenue stream does sunset early, that this will be in line to make sure that it's prior than the actual date of when those sales tax revenues would stop streaming in. And then we have in 2023 an estimated project fund of $151.4 million. 15 of that will be taxable. And right now, when we were talking about the taxable tax exempt curve, they're kind of right on top of each other. So we've put this in 32 to 34 when looking at this and structuring it because and rather than pushing it up front and increasing the earlier maximum annual debt service for the district, we put it out a little further back, but that's something obviously when we come to do that financing, we'll look at what the market's doing at the time to make sure that's still the best move as well.
And that taxable piece, if you recall with the last COPS issue, we did a portion that was taxable for a project called Delray Full Service. And there's a lot of public use space and a museum and other things contemplated. This next one is for Roosevelt Full Service. and there's a lot of discussion about what's going to be at that facility. And again, it will probably be a lot of public use, a lot of, there's going to be a museum, lots of discussion about possibly putting a clinic, putting some other things in that building that doesn't necessarily fit into it could cause a problem for private use. So I don't want the district to be worried for 20 years on making sure we're using that facility in accordance with the tax laws. So we're avoiding those issues by using taxable debt for that piece.
And then the two other components are an issuance in 2026 for 188 million and 28 for 48 million.
Yeah, and by the time we get to 28, that transaction may be rolled into 26, or part of 26 may be pushed back. I don't think we've ever, would be one school, and I've never done a debt issue other than doing taxable and tax exempt where we broke out one school by itself. So by the time we get there, we'll probably be moving some things around, but I just want to use what we've got right now and make sure it all fits and that we've all seen what we think the projections will look like.
And before any of the issuances moving forward, we'll come back and talk about strategy for the overall capital plan as well moving forward based on current market rates. So on the next slide, this is looking at all of the series put together with a final maturity of 2042. So we're going to talk about a final maturity of 2042, which is going out 20-year debt, and then 2047 out 25 years. And so I know we had originally, kind of pushed this forward for the district. The tan bars that go, are at about 150 right now, and drop down in 2040. That's your current debt service that's outstanding. The green is the layering on of the Series 2022B. And so what this does is the 2022B would wrap in those back to maturities, fill in a little bit of principal and interest in 35 through 40, put the bulk of it in 41 and 42. And you'll see in both of these scenarios from 23 to 29, that's including the pieces that are amortizing early due to the useful life. And that's really, when we look at the numbers and wrap up the summaries, your maximum annual debt service is going to be very similar in both situations, and that's because of amortizing those projects earlier. So it's just interest pieces in the other projects.
And just as a reminder, these dotted lines, the dark one is 75% of the 1.5 mils. That's what's allowed by statute that we don't want to use. This one is half. This is 50% of the 1.5 mils. And the policy, our debt policy says that we have a goal to not exceed that. So we're staying under it. It's going to be really close in 2023. But then we have lots of room to maneuver for future debt out once we get past the first few years.
So on this slide, we're looking at it with the final maturity of 2047. This just allows a little bit more capacity, not on the front end, but on the back end to be able to structure depending on what the market's doing. So Leanne and I had a lot of conversations about this, about when we finally go to issue, would we want to go out 25 years or keep it a little bit shorter and have, the debt expire in 20 years? So those are conversations that I think will still be ongoing based on, market conditions and what we're seeing and what the investor demand is as well at the time, to make sure it's...
Historically, our debt was always 25 years. And then for the past few years, we've shortened it up to 14, 15 years because we had so much capacity once we got past 2030. So we were using all this space here. Everything from 2032 on has been issued in the last 2 years. So we've been wrapping. And this is looking at level debt service as opposed to the prior slide that's wrapping it. It makes it more level. So the conversation we're having is, do we want to go ahead and wrap this again and keep it to where there's nothing out here? We still have lots of capacity, but if we take it out to 2025, you have a lot more, you free up some extra capacity in the out years. And, one of the things I look at is just how much more does it cost to go out? And I think that's the next slide, isn't it?
Yes. So this is looking at the aggregate of today's assumed market rates for the whole capital plan to do all of the financings that we talked about. And if you kind of just hone in on where the box is, the total debt service, Obviously, if we did the maturities in 2042, it's less because the interest is lower versus 2047. Although, you know, when you're looking at your true interest cost, the 4.94% with the 2042 versus the 4.97 in 2047. So we did have a lot of conversations about, but that's where the current market is, where the yield curve is pretty high,
Right.
even, you know, across the curve, and taking that into consideration for future financings as well.
But really, the decision that we need to make today
So the next-
is the next slide, is, we're looking at just what's in green. That's the deal we're doing today. The blue, yellow, and orange is coming up in future years. So this is the whole picture, and now we're looking at just this particular transaction.
So this is assuming, I think just clarifies this again, 23 to 29, both of these graphics are going to have that green up in the front. That's increasing your MADs up there. And then on the back end, you're seeing some principal in 35 through 40, and then the bulk of it in 2041 and 42. And on the next slide, this is what it would look like if we went out to 47. So it would be more just your standard level debt service where there's principal and interest just for this issuance, where the prior one you're getting more of an aggregate level debt service structure down the road. So yes, there we go. So this is what we're looking at, the comparison for the 2022 B issuance between a 2042 final maturity and a 2047 final maturity. With the 2042 final maturity, you are saving about $2 million in interest, which is, you know, resulting in the lower debt service. But as of when we ran these numbers yesterday, where interest rates were, I mean, it was just kind of right on top of each other as well.
So basically, it's an extra $2 million in debt service to go out an extra 5 years. So I think.
Is that the recommendation? What's the recommendation?
Well, I think that my decision, what I make today, may be different on the day when we get ready to price and look at what the market is. It's so market dependent, and it's dependent on the structure. You know, some of the things that we've been talking about is block size, and, you know, if this transaction goes out the full 25 years, and I'm just giving you an insight into what I'm thinking. If we go back to this one, if we were to decide to only go out long-term for this one transaction and nothing else, you know, are investors going to be worried that we have such a small amount in the master lease when we get out to the last 5 years? I don't think so. But there's a lot of discussion on, if we push part of it out to 25 years, do we want to put all of it out to 25 years? But again, we'll get to look at each transaction as it comes up. The decision for what we want to do for this deal, I'm really curious of feedback from the committee. But I think a lot of it, correct me if I'm wrong, Laura, a lot of it's going to depend on what the market looks like when we actually price.
And investors seem to be a little bit skittish on pricings right now. It seems to be a little bit rough. You know, with interest rates increasing, the spreads are as well. Sometimes you hear that doing large block sizes are really attractive to investors, and then other times that's not so great. So there's a difference in the structure of having, you know, the bulk of it in 41 and 42. If there's not appetite in those years, you know, having the principal spread out across might attract more investors when you're bringing it into the market. So those are conversations that could be had closer to pricing, because we're not anticipating, I think, until July to price this. So it still is several months. Well, I guess it's less than two.
Late June. It's June 27th, I think, is the
so about a
current
month.
date that we're looking at. It's
Close
about a
in
month
July,
away.
maybe, yeah.
So, all right, so this is Michael then, Leanne. So what do we need to do today with projecting out that far forward?
Well, today, the initial thought that I need is the approval to move forward borrowing up to the $211 million. If I've got that number right, I think it's $211 million. And I
So
think
I'll make that motion.
Is there a second for that? So the real question is how we do it.
Right.
And the method, how you do it. But one thing you do have to take care of is this part with the sales tax.
Well, and that gets covered just in the documents as a disclosure item of, that we'll be using sales tax to
The
pay.
sales tax will pay as well as the property taxes
Right. But the sales tax piece will be amortized and finished
and early.
very early, based on when the sales tax is going to end. So that would end in 2025.
Not sure you caught all that, but the sales tax only goes out, what, how many more years?
25 or 26, depending on if we
25
get
or
the
26.
sunset provision.
So we're going to have bonds that are payable, the short-term portion of these bonds, or part of the short-term portion, will be paid by these sales taxes rather than general taxes.
And that's it's not separated in these numbers,
It's in here.
but that is included in that debt service piece up there right now.
It's hard.
Isn't that the green part? No?
Yeah, I'm going to see if I can make this bigger, just somewhere. There's a very slight difference. You see, the first 3 years are just slightly higher than the next 4. That little difference there is the sales tax. And these 7 years, it's very small. When you look at the actual numbers, it's there. Because we're only talking about $4 million on a $200 million transaction. But these 7 years are larger because we're amortizing those 4 projects that were supposed to be funded with sales tax that I'm moving into borrowing. That's really deferred maintenance. It's roofs and windows and doors and floors and parking lots. And I don't want to amortize that out to 25 years or 20 years. We're amortizing that over 7. So that's why these numbers are bigger at the front end of the amortization schedule. And then you see the numbers are smaller for several years, and then you can see either level debt service or the wrapping at the end. But I'm guessing that how the structure, I mean, even if I said right now, I like the 20 years, I'd like to keep it short personally, but it depends on what the market's going to bear. And I'm looking at the bankers, and they were all nodding their heads when we said it depends on market. The market is not, I can't tell you how many calls I've had in the last week. There have been some recent deals done, and they were rough. And the investors are they're dealing with inflation, they're dealing with all kinds of issues. They don't want to necessarily lock in rates with a coupon of 5% and a yield of 4%. So it's sometimes hard to get the deals done. So I think a lot of the decisions, while I may come out and say I'd like 20, we're going to talk with the bankers that are working on the deal, and what are they hearing from investors and what's going to sell. Especially if we get down to the point, and Laura, jump in if I say anything wrong. If I'm looking at a $2 million difference, and we get a better price, better interest rate, the better interest rate is going to offset that $2 million in a blink of an eye. So it really comes down to what the investor's going to want with the transaction.
Any comments from our bankers here? Yes.
It's harder.
Out of recent experience, and the other thing is pre-market a long period of time,
Right.
more than you would usually do.
Okay.
You're still going to have some pressure in years 15 to 20. They're still going to be, sporadic, but you're not going to have those large chunks in 25 and 30.
Okay.
It's going to be tough to find some buyers right now.
Okay.
Did I hear you say 10 years, Mike?
I think 10 years, obviously you gotta, I don't think you should go shorter than 20. And one thing I thought that was really creative here is the fact that, PFM with the 2042 and 2047, how the total aggregate debt service is almost identical, and the TIC is pretty close to it. So that's a neat structure that'll give you future financing flexibility. But just, it's the past month and a half has just been ugly, and particularly the past 2 weeks, but we were just checking our phones. The MMD improved 5 to 6 basis points today. That's the first time we've seen that in weeks.
Yeah, yesterday it was a slight improvement as well, so
Oh, good.
it could
be getting better.
Is that a suggestion that inflation might be somehow tamped down?
That would be a Stephen Scott. I don't know the inflation. I won't speak to their expertise on that, but.
Yeah, for the committee, from my perspective, I'd like to make sure the committee is comfortable issuing the debt and delegate the decision for 20 to 25 years to staff based on, and financial advisors, of course, based on the market conditions.
So this will be our approval? at this point? And then you'll go with the board, to the board with
We'll
whatever.
go to the
final
board,
is.
and actually what we usually do with the board, we give them a not-to-exceed amount and a not-to-exceed final maturity. So the not-to-exceed, we're not gonna go beyond 25 years. And the actual structure, when we actually price, is based on what the market's going to do, where we're gonna get the best value, lowest cost of capital.
Okay, so you need
Need a
approval
motion
on this?
to approve the issuance of the 2022.
Well, the
caps
motion
issue.
was made, I don't think we got a
Yes,
second.
you did. And you seconded it.
Okay, and it's already been, okay, good enough. Any further discussion? All in favor? Any opposed? Motion carries.
Okay, we have one more thing on the agenda. Well, there's two, but one, at the last meeting, well, I think it went back to September, we tried to do the election of the chair and vice chair, and the committee wanted to extend our current chair and vice chair. I had to go back to the board to get approval to extend the term limit. We got that December after our last meeting. So we've not met again since that. So we do need to do a vote on our last meeting of 2022 to officially elect our chair and vice chair for 2022. And the way we had it lined up was the recommendation was Mr. Miller as the continuous chair and Dr. McDaniel continue as vice chair. So I'm asking if the committee would like to formally vote on that or change it. It's up to the committee.
Make a motion. Vote.
Okay? I heard a first and a second.
Right, first and
So
second.
all in favor of Mr. Miller staying as chair and Dr. McDaniel staying as vice chair?
Aye.
Any opposed? Okay, and I'm just going to, the other question I have,
All right, yeah.
at the next meeting, which will be in August, it's either right before or right after school starts, and the committee is supposed to elect a chair and vice chair at the first meeting after the start of school. So I wanted to ask the question, if you want to do the same thing and you want me to go to the board and get a waiver of the term limits so that next time you all could just vote however you want, I can go ahead and line that up now. And then when we get to the meeting, anyone could be elected as chair and vice chair. So I was just checking, do you want me to go ahead and move forward with that waiver?
Yes.
I heard yeses. Okay.
Yes.
Okay.
Okay, I will take care of that. And that's all I have for you for the
So
meeting.
then is that it? Are we ready for the future? The future holds some bonds. At who knows what interest rate?
What is the future?
We know that. There's a need. So that was a good meeting, very informative. Thank you all.
Our next meeting is scheduled for August 5th. So that would be before school starts. So it would be September probably when we'd actually do the chair and vice chair, but I want to get that term limit waiver set up. So we'll be looking at the June investment reports. We'll have a capital plan to review to show you the debt service payments and how we're structuring everything. And I hope to have the results of the banking RFP. We're still working on that. I do have a general question. The banking RFP, we were going to bring it in to let you all review it, and purchasing and legal said you really shouldn't have that discussed at a public meeting. So we're doing that, but the committee can delegate and ask a single member of the committee to review the RFP. I can't do it at a public meeting, but if somebody wants to review it before it goes out, it would be completely unofficial.
Oh, you've had your share.
You don't have to. I'm just offering that if you want to.
Jack, are you up for it?
It would not be scoring it or even looking at results. It's just looking at the RFP before it goes out.
Yeah.
And
So
PFM will be doing that also.
if nobody else wants to do it, I'll do it.
Okay. Yeah,
Oh,
it's just
okay,
looking at the document before it goes out, not scoring, not looking at results. I'll ask that question later in case somebody wants to do that. It is completely volunteer and no one is required to do it, but having another set of eyes look at the
We don't get, do we
RFP.
get to vote if we look at it?
The way, we can have a member of the finance committee voting and scoring on the RFP. We didn't do that last time, I don't think. I think the committee said you didn't want to score, but we can do that. Committee members, we can have a member of the finance committee on the panel to review everything. That would be reading them all, scoring them, attending all the demos. It'll be a couple of
Okay,
days,
so how about reviewing? This is reviewing
reviewing the document before it goes
the
out.
document. Okay with you?
Okay.
Thanks, Paul.
I'll send it to you when it's ready. And PFM it's really just looking at it to see if you think I've missed anything, if there's anything I should add to it. And Steve Alexander and team will also be looking at it and giving us feedback before it goes out.
Okay.
Okay?
So if there's no other business, then we will adjourn this meeting. Thank you all.
Very much. I don't know
Well
if it's
done.
raining out there or not, but be careful.